Hello. So, as a brief introduction, my name is Ester. I am head of product at Salv. I've been at Salv for quite a while already, for over 6 years. But over these years, I have been working mostly with our products and making sure we deliver value to our customers. Today, we will be talking about more specifically about transaction screening. But of course, as many of you might be familiar, our product offering is relatively broad, so this is just one small part of it. But before we jump into the actual content, let's talk about housekeeping. So we use Zoom webinars for hosting these events. You will find a Q&A button at the bottom of your Zoom window. Unfortunately, Zoom doesn't allow you to ask questions verbally, so you would need to type everything in. But I would be very happy to answer your questions towards the end of the webinar. So whenever you have a question, just pop it in there and we will get to it at the end. Also, we will send all participants a video recording of today's event, which means you will find it on your email just a couple of hours after we finish here. Otherwise, the webinar is planned to last 30 minutes. We're planning it in a way that I'll talk for around 20 minutes or so, and after that we will get to your questions. But let's get started. Before going to the specifics of transaction screening and optimizing your solutions around that problem area, I wanted to talk briefly about Salv's wider offering as well. Those of you who are listening, who are already our customers, are of course familiar with it. There's nothing new here in that sense. But Salv has 3 products in our portfolio, which on the sort of traditional compliance offering side is centered around screening and monitoring, with a lot of focus on real-time checks and handling larger payment volumes. Screening, of course, being split into person screening and transaction screening. So we cover both. We cover sanctions, we cover PEPs, adverse media, also some custom lists or your own sort of curated list that you might want to pull together. So that's one side of it. The other side is our intelligence sharing platform, which is called Salv Bridge. Today, we won't be talking too much about that side. But if you're interested, if APP fraud is a relevant keyword for you, then again, reach out to us and perhaps there's a common topic to be discussed here. But having said that, let's get into the screening side. So usually all good presentations start with the problem statement, right? And we are all compliance professionals here. So in that sense, there's nothing new on this slide, but just to be on the same page. And we are specifically talking about transaction screening. Although when it comes to screening, well, by definition, high volumes of false positives, that's sort of inevitable, be it transaction screening or be it person screening. But I guess if you do transaction screening wrong, then it comes with a much larger hit in a way in terms of scalability, in terms of bottlenecks, also in terms of friction created for the customers. So how we usually think about it is that it's very easy to say that screening is a sort of exercise in efficiency, optimizing dummy work as much as possible, and all of that. You can think about it from this angle, and it's definitely true. It's a cost center, right? But how we like to really think about it is that in the end, screening does generate a lot of noise. But in the context of compliance, it's important to get rid of the noise in order to be able to focus on what really matters. And of course, what really matters what should matter is, as Salv's mission also says beating financial crime. So no one wants to do this box ticking exercises, or at least focus on box ticking during most of the time in their work and in their efforts. So we have built our technology keeping in mind that we help our customers to focus on what matters. But talking about customers, and actually, well, today's webinar isn't so much about our product, but rather talking about what we think are the best practices to achieve certain goals. So it isn't really a sales pitch, but we did want to highlight one case study. Well, Salv is based in Europe. Most of our customers are kind of spread around within the European Union. We have a lot of customers in the Baltic countries, in Poland, and in this region in general, where perhaps when the war started in Ukraine, the sanctions area became especially painful. Simply because, well, there were so many names being added to the lists, and Russian names tend to be rather generic, which means that they generate a lot of hits. And at that point in time, this is where the case study sort of comes from. So what we noticed is that with our product, most of the customers, or well, this is about one specific customer, had their percentage of transactions that end up in manual review. So by manual review, we mean someone needs to check them before the transaction can proceed. This was around like 0.14%, as you can see on the slides. But at the same time, for other similar companies who were not our customers, it tended to be more around at 1% as based on the insights that we got. And of course, then we started thinking, but why? Like, how does our technology or any kind of technology really support the reduction of that metric? So I guess this is the starting point of today's webinar, and highlighting what are the actual mechanisms. And regardless of the product that you are using, many of these you can implement, or at least some of them you can implement in your daily processes. So on a very high level, what we will be talking about is that we will start from the sort of chain of success. The starting point for the chain of success is actually KPIs, which we will talk about in a moment, because if you don't know what you're measuring, therefore, then it would be very difficult to say whether you are successful or not. We will talk about data quality, which is a slightly controversial topic in terms of screening, especially in terms of transaction screening, but there are things to consider here as well. We will talk quite a lot about fine-tuning and configuration, which is possibly an area that doesn't receive the attention that it should. And we will talk about automation, which usually gets a lot of attention. But yes, indeed, also is an important component in that sense. But moving forward and talking about KPIs, and based on my personal experience, the thing with KPIs is that usually the problem is that there are too many things to measure. And at the same time, none of the metrics are perfect. So, and that leads to a lot of misalignment within teams. People are sort of on different pages in a way that someone tries to suggest a KPI, someone else says that, oh no, that won't work because that KPI doesn't cover this or that angle. And that will always be the case. You will not have an ideal KPI, but you also can't have 10 KPIs, because in that case, no one pays attention anymore. And you have to settle for something, because if you don't settle, then you end up measuring nothing. And as it's also written on this slide, as we have seen it, the number of KPIs you can actually track is maximum 3. Would be better to have even less. 2 is probably the best optimal number in order for people to really focus and track something. Sure, it will never cover all the angles. Then there's the question that what is good in terms of KPIs. And internally, this can be a tricky area because perhaps you are not on a very good level with things that you would want to track. But in that sense, what helps is insights of what's actually happening on the market, and therefore sort of realistic goals, what to strive for, what would work, what would not work. And then the other things that, well, if you have KPIs, it would be good to monitor them, to keep an eye on them. But nowadays, I guess almost everyone has their sort of business intelligence tooling that you can use for that. So usually that side really isn't a problem. It's more about deciding what do you track and how do you work with it. And of course, goals, as mentioned before. But we would like to highlight two main KPIs in today's webinar. One was actually already mentioned. So the ratio of transactions that get stuck in manual review. This is a very good one because it highlights your scalability. In theory, you can also differentiate between different markets here if you do have a sort of global reach with your business, but you don't need to. So, and we were also talking about sort of realistic targets here, what is achievable, what is not. In the case study highlighted at the beginning of the presentation, I mentioned 0.14 as an example. And this is quite a good level because I would say, as we see it, once you hit sort of 0.1, then most of our customers don't really want to go below that anymore because then you are really starting to optimize for corner cases, which you can do, but usually the effort is not worth it. And another one I would like to highlight, which is maybe not so common thing to measure, and I will explain in a second what we actually mean by this. And this is actually a metric that we love across all of our different products, or at least products that touch upon handling alerts, which is meaningful alerts. We don't like to talk so much about true positives, because of course, especially in terms of screening, true positives are real corner cases. This low percentage that you would see for actual true positives, you can't drive that. You don't even want to drive that. But as I mentioned in the beginning, it is important to understand if your team is actually working on what matters. How do we define what matters? Usually, well, we set up the definition of meaningful alerts based on different combinations, which on a high level boils down to how much time did it take to investigate a particular case. Usually, if you can close something down in 2 seconds, it probably wasn't very meaningful. And if it takes a human 2 seconds to decide something, then I'm quite sure that a machine would have done it even faster, right? So this is where the sort of machine thing comes into play. But meaningful alerts, of course, here it is also more difficult to set the target, especially if you start looking at different markets, because the sort of naming standards there are different. If you're operating in the Middle East or Africa or also South America, usually, then what happens is that there you will get more of these so-called meaningful alerts because the names, unfortunately, will be more similar and will require more investigation effort. But from KPI side, that is actually all. So let's get to how to do this. I mentioned data quality previously. I also mentioned that it's controversial, but it's still something to highlight, especially when it comes to transaction screening. In many cases, you will not have the power to influence the quality of the data that comes in. That's just the unfortunate reality. But there are things that you can do. For example, in your screening engine, whichever product you are using, provide as much context, and by context I mean data, as much as possible, because the context actually enables you to automate things on a better level, enables you to get rid of this meaningless work, helps you to teach machines to resolve alerts for you, and all of that. So just some examples here. Again, we're all familiar with it, but full names, of course, avoiding titles as much as possible, because titles do not really help with fuzzy matching. Instead, they confuse the algorithms often. And in addition to titles, same thing applies to company suffixes. Usually with screening technologies, these algorithms actually try to get rid of these short titles and suffixes, but if they do not exist in the first place, then that's always even better. What else? Configuration. So this is a topic that we really love. In an ideal world, when it comes to screening, how configuration should work, is that whoever is the owner of your business logic from compliance side, whoever is the decision maker, should also have the power to apply configuration. If it works in a way that you need to rely on your IT teams in order to implement any changes, then this is bad. Because first of all, it generates costs for you, it makes you slow to move, and in the end, if you think about what's the value of configurability as such, and we will bring more examples here in a moment, the end value is that all configuration, in addition to driving your risk appetites, should also drive your efficiency. So, and it does. If you configure your engine properly, you can reduce your workloads by a lot. So, examples. Why do we think so? Because again, country by country, the expectations of regulators are often different. So those of you who are licensed in different countries will encounter this, and actually you can use it in your favor by, for example, applying different fuzzy matching scores, applying some risk-based decisions where possible. For example, in some countries, it might be acceptable not to screen payments under a certain threshold. And of course, that threshold would be very low, but it still comes with a significant impact. But then the question is that, does your screening engine support this kind of flexibility, or it does not? So different examples here. I already explained some of them, so I won't go over all of it. Obvious one is internal payments, and perhaps not screening these, which would be allowed in most cases, and then applying different sort of layers of controls for international payments. But a very good example from recent times is the new instant payments regulation that's coming into force scarily soon. And it can be scary, but it's also an opportunity, again, as long as your technology allows you to comply with the regulation, because it's not only about complying, but in terms of complying, if you are now allowed to process instant payments within Europe or within EU, to be more precise, without screening them, then that's a massive opportunity to cut down your workloads, costs, but also customer friction, which was the point of the regulation. But then technology can often become the bottleneck. So that's the problem. But as long as you have the configuration layer, it's all good. Some other points to cover. Automation. So this is something that most screening engines actually do, well, I can't say relatively well, but they have different components of it. Good listing nowadays is sort of table stakes. Everyone has it. But maybe one thing to highlight regarding good listing is the flexibility of it. Often there are some minor updates in sanctions lists which abolish your good listing. So again, you need the configuration around it to define what's actually a significant update in a list and what would be considered minor and completely irrelevant. So also making decisions on a counterparty level. So it isn't just a transaction on my customer profile, but it's a transaction in relation to some other entity. And it depends what type of entity it is. So having these capabilities. And then in the end, automatic resolution of these obvious false positives. So be it a rule engine, be it some AI-based solution, it doesn't really matter. But what matters is how easily you can adjust it to your needs, to your risk appetites, to what you are learning in your operational processes. And if you do all of these things well, and if you combine it with the configuration layer, then you usually end up at around this 0.1%, or at least it isn't really a challenge to do it well. So here you can see some quick examples around that with some Russian names, some very minor differences in names, minor in terms of, from fuzzy matching perspective, these names are very similar, but it is actually possible to automate the solution around these types of patterns. And finally, is the sort of streamlined workflows. Why it wasn't mentioned before is that by the point where you get to the actual investigation, the friction is already created. So a transaction is likely stuck somewhere, or a customer onboarding is stuck if we talk about KYC screening. But after that, there is the following step, that how do you streamline your workflows? This isn't a topic for this webinar really, but I did want to mention it briefly because we have seen that with good technology, with a good user interface that brings everything together in the decision making, you can actually cut down the decision speed by around 5 times. That's achievable. So that's still a significant impact to your cost. Very briefly also around the RFI process. So again, once you get to an RFI, you have already, it's a transaction stuck. It's actually a meaningful alert as well, because, well, if you're sending an RFI, then it is meaningful. You cannot resolve it on your own. But you can also automate processes around that. So sending RFIs to customers, to partner institutions, and fetching the information that is returned in a structured format. So you would get the full name and date of birth as a standard example, and just resolve everything automatically. But as we are rather tight on time, I will not go through the summary because this is all what we discussed today, because I think we did have a couple of questions here. So I need to stop sharing my screen so I could actually see your questions. Okay, so there's a question. How do you justify the usefulness of real-time for AML use case? Good question. I guess it comes from the beginning of the presentation when we talked about the general solution. So, well, it is very justifiable, but not in all cases. So you shouldn't go overboard with it. But at the same time, when it comes to actually, again, beating financial crime, then in order to be able to do that, you need to be able to stop the flow of the money. So not everything can be retrospective, but you need to balance it, sort of, very briefly speaking. But this is another topic, not the topic of this webinar, so I won't go too deep into that area. But then another question, how do you remove the need for the IT team from the update of configurations? That is actually very straightforward, or at least how we have done that. Basically, the question there is, where do you keep your business logic? Think about it in terms of, you have a screening product that you're using. You have an API integration for that. Especially for transaction screening, you don't really have any option because it has to be real time. So now the question is that, do you make an API call for each of your transactions? Maybe when you integrate a new product, you would do that. But then you suddenly decide that, but I don't actually want to screen transactions that are under 10 euros for some countries. Okay, what you do now, you can ask your IT team to modify the business logic on your end and only make the API call or not make the API call in this scenario. Okay. Or then with our product, what you can do is that your decision maker can just log into the product and apply the configuration there. So the API calls still happen on your end, but the transactions will not get stopped under some circumstances. So that's what we mean by keeping the business logic. Okay, is the process of stopping money only within country, or is it possible within EU or outside EU? Oh, of course, it's possible everywhere. It depends slightly on the regulations, but like what you can stop, what you cannot stop. But technically speaking, it is possible. I realize we are running out of time here, so the webinar will end in 1 minute. And there's one more question I can see, but perhaps we can answer that afterwards, as I think we unfortunately need to wrap up here. But next time we will plan some more time also for questions. So thank you everyone for attending. Hope it was useful for you, and hopefully see you soon. Thank you. Bye bye.